Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining us at the market site in Times Square, Bob Yawger is back with us. He's a senior energy analyst over at Mizuho Americas with his 2020 energy outlook piece. Bob, great to have you with me as always. And before we get into 2020, since I've seen you last in November, we've had an OPEC meeting, we've had the Saudi Aramco IPO, and markets continuing to sort of trade within that range that they have been in for quite some time.
It's true. It's at the highest level since the Saudi attacks in September. Not exactly ripping to the upside, considering you got two big, taking some supply off the market as a function of the OPEC meeting and increasing demand as a function of the trade deal. Market's not really ripping to the upside here. We got to $60 and it's struggling against this level here. I think the uncertain nature of both developments has really slowed down the progress here. Interesting to note that at this point right now, the speculative community has loaded up on their long position. They loaded up last week, basically through both events, and they increased their long position by 52% last week. That was the largest percentage increase in 3 years. But now we're at this area where nobody really knows exactly what's the story with the OPEC deal. Are the Nigerians, the Iraqis, are they going to cut back on production, which is going to incentivize the Saudis to also cut back on production? Then the trade deal. I mean, we haven't gotten the details on this thing yet. So I think there's some skepticism there, too. As long as equities continue to do pretty good, I think we will hang out in this area. But if we get a pullback in equities and we get certain storage builds in crude oil in winter, we could run into trouble, especially with that loaded long position.
So when we talk about the trade deal, and this might seem like an amateur question, the demand doesn't change for me. I'm not going to drive more or less. So when we talk about demand going up, what pockets of industry drive that demand?
Manufacturing would be the big issue. I mean, it's not really a gigantic part of our economy. Not to mention that the purchasing power of the individual, you would tend to maybe buy a couple things for Christmas that you might not have bought otherwise if you know there's a certain degree of certainty going forward in the economy. Hey, listen, the unemployment is at a really low level. Everybody has jobs. People are going to start getting raises. There's going to be more money flowing through the system. As long as we keep this trade deal going forward. If we don't, then you have to recalibrate.
And that's the next question for 2020. And even let's talk about the equities for a moment, because clearly that question is, okay, when do energy stocks become a value story here?
Yes, and there are people that believe they should be right now. It's the only sector really that's in the red for 2019 here so far. So why not try and pick some of them off and see what we can do to the upside? Really, at the end of the day, in my opinion, is the fact that you just have so much crude oil here in this country. We just cannot get out of this range in crude oil from $50 to $60, basically. I mean, it's the E&P types make money at in that range, but it's not a rip-roaring take-off to the moon type rally that it inspires. So I think folks are a bit reluctant because of that. And with the current storage situation, there's not a lot of reason. We're above last year's storage level. Our refinery is only running at 90 to 91%. That's a low number for this time of year. They should be running at closer to 95%. That tells me there's not a lot of demand in the economy. And if you don't need the crude oil to make product being gasoline and heating oil, then you really don't need the crude oil. So we could run into trouble here if there's a soft patch in correlating equities.
Well, I mean, it's a double-edged sword, though, because if oil does move higher, then that impacts consumer spend, right? So it's 6 to 1, half a dozen in the other.
It's the circle of life.
Well, and it certainly is. And I think right now, you know, as we're looking into the elections in 2020, the administration certainly wants to keep oil prices low to keep that consumer spend going.
Yes, that would be ideal. And there will come a time, I'm sure, where President Trump will put some kind of tweet out there that would has something to do with how great we are or how OPEC is not in control of the situation anymore and talk prices down a little bit. But at the end of the day, gasoline is cheap, relatively speaking. The relative price of gasoline to crude oil is cheap. It's single digit. So when the crude oil goes through the refinery, about a barrel of crude oil goes to the refinery at 20, wherever the price is here now, $55, $60, basically you make about $8 off of that. The crack is what it is called. It comes out at about $8, $8, $9, and that's not very good. Refiners want to make more than that. They are making money off of heating oil, but that's also a seasonal phenomenon this time of year. They're making about $24 off every barrel of heating oil right now, so they're doing pretty good there, but the gasoline is, it's not all
So for 2020, unless there's a change in the supply situation, you think we're going to be kind of where we are right now?
where we are, I would not be, we have not printed below $40 in almost a year. I would not be surprised for the storage situation to build to such level that we did see $40 at some point. I'm not looking for a wipeout situation at all, but I would be surprised if we didn't print $40 at some point this year.
All right, Bob, we'll see you in 2020. Thank you so much for joining us throughout the year in 2019. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.